VIX started to move up. Again, bad news for USA stocks or bull market. August 22, 2024. On August 5, global markets experienced a significant wave of volatility, with Japanese stocks plummeting by double digits as the Bank of Japan initiated a rate-cutting cycle. Meanwhile, all three major U.S. indexes closed the day down by 3%. As stocks dropped, there was a sharp spike in the CBOE Volatility Index, VIX, which reflects traders' short-term expectations of price movements in the S&P 500. When the VIX trends higher, it indicates that traders anticipate more volatility. At the start of the month, the VIX soared to a multi-year high, signaling extreme market fear. However, the situation has since dramatically reversed, as if that spike never occurred. This phenomenon, where the VIX surges rapidly and then collapses just as quickly, is known as a VIX crush. Such severe VIX crushes are rare. Curious about the historical impact of similar events on investors, I analyzed past occurrences by comparing VIX movements with stock returns dating back to 1990. On August 6, the VIX dropped by 28%, marking one of the largest VIX crushes in 24 years. Only once before, on May 10, 2010, has the VIX fallen further in a single day. That previous instance occurred when markets began to calm down following concerns about a European debt crisis and fears that Greece might default on its financial obligations. All four of the previous VIX crushes forecast big gains for stocks. Historically, these opportunities have returned an average of 17% in a year, more than double the return of a typical buy and hold strategy. So, is it time for another bull market, or is it a sign that big investors are getting ready to shift? If another big spike on VIX happens, could it signal an imminent market crash? Well, many key factors need to be watched closely, because fear on the market could be spreading out. On August 5, Nikkei dropped 12% in one day, the largest single-session drop since Black Monday. Then, on August 6, the Nikkei enjoyed its biggest one-day gain since 2008, and it's been inching higher ever since. The Japanese stock market collapsed in early August, causing knock-on effects on the global economy. Carry trades, borrowing in low-interest currencies to invest in higher-yield assets, played a significant part in the collapse. Experts say. Reuters says the Japanese yen has been a popular choice for carry trades due to Japan's long-standing policy of maintaining extremely low interest rates. Investors borrow yen at these low rates and use it to buy currencies like US dollars, Mexican pesos, or New Zealand dollars, which offer higher yields. The question now is, how healthy are those players who are trying to catch high returns borrowing money? Also, is everything okay now with all those lenders? Well, time will tell, but one thing is sure, this was not an ordinary occurrence, and there could be more cards in the hat, and investors should be paying close attention. If VIX starts to spike again, it will be a bloodbath in the stock market, so hope for the best and prepare for the worst. Learning about the VIX. The Volatility Index, VIX, measures the level of volatility in the stock market. A low VIX indicates low volatility, while a high VIX typically signals heightened market fear. The VIX usually increases when stocks decline and decreases when stocks rise. Some investors use this pattern as a strategy, buying when the VIX is high and selling when it's low, but this approach should be considered alongside other factors and indicators. Smaller investors often watch where large institutions are accumulating or distributing shares, aiming to position themselves advantageously. Monitoring the VIX, however, is more about understanding whether institutions are hedging their portfolios rather than directly buying or selling shares. Large institutional investors, like ocean liners, move slowly and create significant market waves when they change course. As a smaller investor, you want to avoid being capsized by these shifts. Institutions can't quickly sell off large stock positions in a bearish market. Instead, they hedge against potential losses by buying put options or selling call options. The VIX is useful for tracking these institutional moves because it reflects the supply and demand for options and the put-call ratio. Options have both intrinsic and extrinsic value. Intrinsic value is the stock equity's contribution to the options premium. Extrinsic value includes the time value, the premium paid until expiration, and implied volatility, which represents how much an options premium can increase or decrease based on supply and demand. Since the VIX measures the IV of S&P 500 index options, these options tend to have high strike prices and expensive premiums, making them less accessible to retail investors. Instead, retail investors often opt for less costly alternatives, such as options on the SPDRs and P500 ETF Trust, SPY, which tracks the S&P 500 index. When institutions anticipate a market downturn, they typically buy put options as portfolio insurance. This increased demand for puts drives up the VIX because the IV rises alongside the surge in demand, causing option prices to increase as demand outpaces supply. A mantra investors learn early on is, when the VIX is high, it's time to buy. When the VIX is low, look out below. The VIX measures the market's expected volatility over the next 30 days using S&P 500 index options. A higher VIX indicates greater anticipated volatility and market uncertainty, while a lower VIX suggests relative market stability. Key levels and trends in the VIX can guide trading strategies. As a contrarian indicator, the VIX helps investors identify market tops, bottoms, and pauses in trends. It provides insight into the sentiment of major market participants, aiding traders in anticipating trend changes and selecting the most effective option hedging strategies for their portfolios. Do you think the USA stock market is ready for another bull market, or is it getting dangerous? Let me know in the comments below. Thanks for watching. Good luck and good profit, by Edward Cash Trader.